Hi, I'm Bill St. Clair, shareholder here at St. Clair CPAs. And today we'd like to talk about three very key areas that don't have a lot to do with accounting, but have so much to do with your entire life cycle and personal wealth as well as family wealth. And that is getting ready for business succession. And then after you have business succession, what do you do with your money? Retirement planning. And then if you have retirement planning, how do you make sure the money stays in your family? That's called estate planning. These three things are so important in everyone's life. Whether you have a lot of money or you don't have a lot of money, it's still important to make sure that you go through this entire process and understand the things that are out there to help you. So the first step you do in business succession planning is what we do is we meet with the owner. We need to understand what we need to do for them. The most important thing is to understand their goals, their expectations. What do they expect? The most important thing that business owners have is somebody they can rely upon. They need to know that there's somebody in their corner to take good care of them and give them a proper path that they'll ultimately decide. So we give options, but at the end of the day, what do they want? What do they expect? What kind of money do they think they're going to get? What type of longevity do they still want to be in the business? Most important thing about business succession is to start planning this 3 to 5 years before you decide to leave the business. Because from a financial standpoint, having your documentation in order, having your financial statements and tax returns done properly will only enhance the value of your company. What do we do when we first get involved and after we come up with the scope of work for the owner and their goals and expectations? The next is the most important also. Information gathering and document review. This is what an outside buyer is going to rely upon. So what we do is we gather up the tax returns, the financial statements. What type of entity are you? Are there anything, road bumps, speed bumps in there that will take away the value? We try to address those items now. Make sure that your business is clean from a standpoint of a sale. And most importantly, making sure that you get the best presentation to your potential buyer. So we go through internal controls, your systems, your manuals, your employees, the key employees. How can the company operate without you, the business owner? So the most important thing is to make sure that this thing is a functioning cash flow entity so that the buyer wants and will pay you more money for because of that cash flow. They give you multiples based upon that cash flow. So it's so important to try to make sure that the bottom line becomes as strong as possible a few years out. That enhances your value for a sale. That leads to the most important thing of business valuations. The most business valuations are very subjective. They can be done whether it's a ballpark calculation between competition, friendly competition, where they both know the business, they know the industry, and they just will come up with a number. They can be done by existing buy-sell agreements, which was probably the weakest of the bunch, but important from a different angle for retirement planning. Um, Most importantly, they'll try to look at cash flow, as I mentioned earlier. They're going to look at your EBITDA, which is your earnings before interest and taxes and depreciation and amortization. That is the net cash flow of the company, and they'll give you a multiple on that. That's a very prominent way of valuing a company. You can also do internal revenue code valuations for internal buy-ins and buyouts of maybe key employees taking out an owner, and that way it's a very more fluid way for number crunching and coming up with discounted cash flow and capitalization of earnings to give a value that the IRS would accept for any sort of internal shareholder buy-in, buyouts, or gift and estate planning purposes. So the business valuation is what you're going to be paid on. So important to make sure that you come up with the best possible light. As always, any business valuation is based upon a willing seller and a willing buyer. So if you don't have those two happening, the sale doesn't consummate. So make sure that you give yourself the best foot forward in negotiating a strong business valuation with a solid full business valuation report to back it up. So when you're talking to a potential suitor, you know it's going to look good. Lastly, and by no means the least important, is the actual business sale process. It's so important to have trusted advisors around you when you're doing this. You need your law firm to negotiate the agreements. You need your accounting firm to negotiate the numbers and the values. That's why we take such an active role in this, to try to get our clients the most money as possible. Because after this is what you're going to live on for your retirement and future earning streams. So the most important thing is gather your team around you, start strategic planning for the potential business sale. As I mentioned earlier, 3 to 5 years out is when you should start that, and keep looking at it on an annual basis to make sure that it's updated and done properly. Eliminate the road bumps that will decrease values. Make sure that you have the best value possible, and then you start strategically planning with your team for the agreements. What type of entity sale do you want to have? Will it be an asset purchase where you might not get the most advantageous tax advantages? Or the preferred methodology is always a capital gain, where you sell your stock or your partnership interest to an outside buyer, and the entity doesn't change much other than the ownership sale. Therefore, you're paying the least amount of tax under today's current laws. We can help in those areas, very much so. Even if it is an asset sale, there's structures and language to put into those asset purchase agreements in order to give you the largest portion of capital gain as possible, with a listing of the assets in the various categorizations that the willing buyer and willing seller will agree to. We try to help, and this is where we really can save you a lot of money from that tax savings angle, along with the valuation process and negotiating all the proper systems to allow you to gain the most. After you go through the strategic planning process, you're going to find potential suitors, potential buyers. What happens then? Due diligence. That's a fun part. And these buyers want to kick the tires and get to know your company inside out. And they will ask all kinds of questions, repetitive times, with an amazing amount of information of what they'll gather. So you need your legal team and your accounting team to really weather this storm in order to get you the number that you would like, and also to consummate and complete the deal. Due diligence isn't something to be afraid of, but it is tedious and time consuming. But ultimately, it leads to your settlement and very happy seller of your company. Next, we'll go into retirement planning after you get the proceeds from your business sale. After the sales process, we start to look at retirement planning. Since your regular recurring income from the company is no longer, but you are going to receive a lump sum, a large nest egg, you need to make sure that you have the proper methodology plan, no different than your business plan when you're operating your company, for your personal life. So many people don't understand. They do planning for their company and never plan for themselves. Well, now you're planning for yourselves, because the ultimate goal is wealth. The business generated your wealth. Well, now you want to make sure you keep the wealth and that you have it throughout your lifetime to live enjoyably. So what do you need to do? The first thing that we always recommend is to create a statement of net worth. Understand what your assets are, what your liabilities are, or debt, and then what the net of those two amounts give you your net worth. At that point in time, we believe for a safe, secure financial future, you want to become debt-free. A person in their retirement years that are debt-free really have no issues to worry about. People can't bother them. They can't hassle them. So we try to come up with a debt restructure program to get you out of debt as quickly as possible, not to look for paying a whole dollar to get a tax write-off for 30 cents or 40 cents. That doesn't make sense in your retirement years. Using people's money at that point in time is not what you want. You want to make sure that you can just live your senior years enjoyably. After that, you want to look at your cash flow. How important it is for your lifestyle to maintain the way it's always been. That's cash flow. Well, to do that, you got to make sure you have enough cash flow coming in from your investments, and you want to create where you have aggressive investments that can still keep making you money, but you also want to take care of your lifestyle expenditures, and that needs to be fixed income type investments. There's many investments to go into. We're not doing that today in this video, but we can help you in that endeavor as well. So want to make sure that you have enough steady income coming in between Social Security and your fixed income to make sure that your lifestyle maintains the same. Thereafter, you have to start looking at your insurances. It's so important and proper to make sure that you don't have any risk coming at you. So this risk assessment and having the proper insurances will make sure, no different than when you had your business, you have nothing that will come back to haunt you in your retirement years, whether that's auto insurance and homeowners that everybody takes for granted, that you use it or lose it type of insurance, to where, from a personal standpoint, maybe you want to create some life insurance because you don't have enough for your spouse or your children educational needs. So insurance and risk assessment is so important, but it also goes in conjunction with Social Security and Medicare supplements. Something that most people don't realize is you need to, even if you do not apply for Social Security at retirement age, which most people right now are around 66 to 67 at the oldest, for full benefits, you need to apply for Medicare at age 65, and you have a 6-month window in order to do that. And if you don't do it, you pay a premium for the supplement thereafter for the rest of your life. That's something that nobody wants to do just because they didn't fit a government window of 6 months. So it's so important to make sure that's done properly. You can take Social Security out at age 62, probably will break even somewhere around age 78 to 79, or you can hold to full retirement age of 66 to 67, which will give you full retirement Social Security benefits at that point in time. Or another methodology is you could hold off to age 70 if you don't need the money, because it earns you 8% interest between your full retirement of age 66 up to age 70, which is a nice return as well. Medicare is something you will have, and you'll be quite comfortable with Medicare as long as you get the supplement that goes with it. You want to make sure that you have it covered for your hospitalization, your doctors, as well as your prescriptions. And there's all different variations of that. Medicare is a very complicated section along with Social Security. So all this we cover in retirement planning, which is so important to protect you in your life. Last but not least, investments. How do you invest properly in order to make sure that you have enough cash flow coming in, which we started on in the first place? There's so many things that we can help you with in the investments. We're investment licensed as well as insurance licensed. So all these things throughout your life and retirement years, we can help you with, both from an accounting perspective, a tax perspective, your life insurance or insurance needs, along with your investment needs. Here at St. Clair CPAs, we're really looking to help you in your years when you're going to enjoy life the most. After retirement planning, nobody really wants to talk about this, but estate planning is so important for maintaining family wealth into the future. You know, we all know we're going to die one day, and we don't like that idea. But making sure that you come up with the right plan, just as you do with your business or in your retirement years, different than how you educated your children getting through college, or just how you got out of debt paying your mortgages and lifestyle debts off. You need to do the same with the estate planning. Estate planning is no more than understanding that you're transferring your current wealth to the next generation or two without a lot of taxation or a lot of hassle upon death. So the simple part of estate planning is about 5 steps that would probably cover about 90% of Americans. And the first step is the legal documents. Everybody needs a will. And in conjunction with a will, you need durable powers of attorney, both for healthcare and assets. God forbid you get in a car accident and you and your spouse are incapacitated. Who pays your bills? Well, that's why you need a durable power of attorney for assets, so somebody could pay your mortgage or your health insurance bill or whatever. Healthcare, of course, do you want the doctors and hospitals deciding how you're going to be cared for, or do you want a loved one, a family member, to make the right decisions for you? That's the durable power of attorney for healthcare. The will, of course, there's simple wills and there's complex wills with trust created and things along those lines. We bring attorneys in to help you guide that. But the first thing that we do before we bring the attorney in is to make you understand the options that you have. In a will, there's 4 basic components. You need to appoint somebody to be the executor or executrix. That's the person in charge that is to liquidate your estate and give it to the people that you love, your beneficiaries. That's the second point. Do you give it to your spouse? Do you give it to your children? Do you give it to charitable organizations? They're all your decisions. This is your will. Wills aren't joint. They are individual. So you can have a different set of circumstances between you and your spouse. The most important thing about the will is making sure it's documented of what you wish. And that executor or executrix has to follow those guidelines. Your beneficiary should be very thankful that you did all this planning properly so that they get the lion's share of your inheritance. Now, the third thing that you have to look at is, are there any minor children? Do you want to give money to grandchildren? That's when trust will be created out of a will. And that's very important too, but a little too complicated for today's video, but they are components there. Last but not least, and people don't pay attention to this portion at all, the will is only one little portion of your estate plan of transferring assets upon death. Other things that do not get governance by the will are life insurance policies or IRAs or even annuities. They have separate designation for beneficiaries. It's so important to make sure that you check the paperwork of your designated beneficiaries in these products to make sure they agree or in conjunction with your will. Because if they're not, no matter what the will says, those companies are forced to go with whatever you designated based upon the initial paperwork and or the revised paperwork that you did over your lifetime. We always recommend these wills and these designated beneficiaries are looked at least every 5 years to make sure they're to what you want and how you want it. After we go through the legal documents, now you're talking about ownership. That's step 2. Ownership is not as complicated today because in the past, it was very important to make sure that you would maintain the unified tax credit, which is the exemption the government gives you upon death. So a husband and wife had to make sure that they each own assets to get the maximum unified tax credits. In today's world, the rules have changed in most states and at the federal government level that there's portability. Portability allows that fluctuation between spouses. So ownership isn't as important. However, in this day and age of change, you never know when it will go backwards because 2025 is the latest date for the current tax law, and then we revise back. So ownership will still be important. So keep that in mind. Third step is gifting. Gifting is so important to try to do while you're alive. And you can reduce your estate because many times people don't realize they're earning money on their investments. They aren't spending as much as they're earning, and their estate keeps going up. The last thing we want from an estate planning standpoint is for your value to go over that unified tax credit limit, which today is over $11 million, which is quite substantial. But come 2025, it's going to drop down significantly again. So it's still important to be paying attention to. When you're gifting, you're allowed to give that amount of money to your children or your loved ones throughout your family. And then you don't have to worry about it come death. And it's also nice to see them receive money while you're alive, put smiles on their faces, and puts a big smile on your face as well. It's something that is very gratifying because I do it myself. So after you go through those steps, which is all controlled by you, there's no real fees built in there other than maybe paying an attorney for the proper legal documents, which is so important. Fourth step is an insurance product. Lots of people, especially when the unified tax credit was low, would create an irrevocable life insurance trust. It's called an ILIT. And these ILITs are only based upon normally husband and wife getting a life insurance policy because life insurance is so much cheaper based upon 2 lives and the mortality of a lady living longer than a man. And that keeps insurance costs low, and it used to pay for the estate taxes, the death taxes. So upon death, if you go over those limits, you pay a certain amount to the federal government, but upon death, you normally pay inheritance taxes to the state on a regular basis. So it's still something, if you want to preserve your estate, this life insurance is a great leverage program. There's no way that your state's you're going to outlive the leverage of what the life insurance is going to give you. And one thing we all know is we will die, unfortunately. So having life insurance as taking care of the tax liability of the estate or as an additional gift to your children is also a wonderful thing. Last but not least, people don't pay attention to it and they don't like to do it, but long-term care. It's so important in this day and age. We're all living longer. And the longer we live, the more costs come out of our family wealth to take care of ourselves. Because as we grow older, we need help. So having a policy to take care of long-term care is a very wise move for preserving wealth. There's different types of long-term care policies out there. You can get the use it or lose it type, like auto insurance or homeowners. Don't always recommend that, though it is somewhat cheaper because it's not regulated enough. They keep changing the actuarial calculations as to what they need so they can increase premiums, which people don't appreciate. They also have policies out there now where you can parlay a life insurance policy and a long-term care policy together, which is a very good move because you know you're going to either die or you're going to use long-term care, so you're going to get the benefit for the good of your family and for the good of you. So please take these 5 points into preparation of your estate plan. They're so important, And if you take care of those 5 points, your estate plan is pretty much accomplished. But we're here to help you in this wonderful process of life. One of our taglines is accounting for life and advising for life cycles. As you can see, this is the advising for life cycle part. Whether it's business succession, retirement planning, or estate planning, we have experts throughout our entire organization that can take care of you, your goals, and your expectations to make sure that you have a comfort level in your life. Please reach out to us, and we look forward to helping you.